You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Right now, like in your own city, it probably costs way more money to build a brand new house from scratch than it does to just, buy one that is already sitting right there on the street.
Yeah, I mean, it sounds completely backward when you first hear it.
Right. It feels like a glitch in the Matrix or something.
It really does. You assume that technology and modern supply chains should make building a new house cheaper, more efficient over time.
Yeah. Oh, boy.
But the current economic reality has just flipped that assumption entirely upside down.
And, well, that flip is exactly why you're here with us for this deep dive today.
Exactly.
Because if you are a beginner who's been looking at real estate over the last few years, you've probably been dealing with this very specific kind of financial whiplash.
Oh, absolutely. The signals are all over the place.
Right. On one hand, you see these headlines screaming that mortgage rates are hanging out in the 6% range, the housing market is just totally frozen, and, affordability is at rock bottom.
And you feel like you just completely missed the gold rush of 2021.
Exactly. Yeah. But then literally right below that, you see alerts that rents in your city are surging.
Yeah.
And massive Wall Street institutions are quietly buying up, like, entire neighborhoods.
It really feels like a puzzle where the pieces just actively contradict each other.
Yeah, and the natural human response to contradictory data is to just freeze, right?
Yeah, pretty much. When the signals are flashing both red and green, most people just, sit on their hands.
Just waiting.
Waiting for a perfect moment that, frankly, never actually arrives.
Which brings us to the big question that we are going to try to answer today.
The $1 million question.
Literally.
Yeah.
Is 2026 actually a good time for a beginner to get into real estate, despite the higher rates and all these affordability challenges?
And to figure that out, we are untacking a really phenomenal stack of source material today.
We really are. We've got this high-level institutional research from Morgan Stanley covering their 2026 market recovery outlook.
Right. And then we have the granular, on-the-ground demographic and market data from Atlas Real Estate.
Yeah, and we are grounding all of that high-level theory with a practical, step-by-step beginner's guide to residential investing.
Because the mission today is really to just strip away the jargon, look at the underlying mechanics of this market, and show you how to actually do the math.
Because real estate isn't about guessing the future. It's about, understanding the forces at play and finding the numbers that actually work.
Exactly. So let's start with the big picture.
Let's do it.
Why 2026?
Right. Why now?
Well, the analysts over at Morgan Stanley are pointing to 2026 as a definitive inflection point.
Okay, inflection point.
Yeah, because we are coming off 2 full years of declining property values in certain sectors, followed by a 2025 that was, honestly, basically stagnant.
Just flat.
Just completely flat. But they are now forecasting a very real recovery in both valuations and transaction volume.
And the core driver of this recovery is that mathematical glitch we mentioned in the intro, right?
Yes, what they call the build versus buy dynamic.
Okay, let's unpack the mechanics of that. Why does it actually cost more to build than to buy? Because, to a beginner, a pile of wood and a vacant dirt lot should theoretically be way cheaper than a finished, landscaped, existing home.
You'd think so, but you really have to look at the compounded costs of construction today.
Okay.
It is not just the raw materials, though, lumber, copper, concrete. They've all seen massive price fluctuations.
Well, for sure.
But it's also the cost of skilled labor, which remains incredibly scarce right now.
Right.
It's the cost of local permitting, which takes longer and requires so much more administrative overhead than it ever did before.
Yeah, the red tape is crazy.
Exactly. But the absolute heaviest weight right now is the cost of capital.
Because of the interest rates.
Exactly. Construction loans are generally short-term variable rate loans.
Oh.
So in a higher interest rate environment, financing a 2-year build from the ground up, it just completely destroys the profit margin before a shovel even hits the dirt.
Wow.
Yeah, developers run the spreadsheet, realize they're going to lose money, and they simply cancel the project.
So they just stop building entirely.
Pretty much.
And when they stop building, they choke off the future supply of housing.
Exactly.
This actually really reminds me of the used car market just a few years ago.
Oh, that's a great comparison.
Right. Remember when the global supply chain broke down and there was that massive shortage of microchips?
Oh, yeah, the automotive industry just completely seized up.
Right, because Ford and Toyota, they literally couldn't get the microchips, so they couldn't manufacture any new cars.
Production just stopped cold.
Exactly. So what happened? The used car market went absolutely vertical.
It went crazy.
Because if it is fundamentally impossible to build a new car, that, 5-year-old Honda Civic sitting on a used lot suddenly becomes incredibly valuable.
Because it exists.
Exactly. It finds a very hard, very high price floor because people still need to drive to work.
Right. And real estate is experiencing the exact same phenomenon right now.
Just on a much bigger scale.
Exactly. If developers cannot afford to build new apartment buildings or, single-family neighborhoods, the existing structures are the only game in town.
Because people still need a place to live.
Yeah. That used car parallel perfectly illustrates the mechanism at work here. Existing properties become structurally more valuable simply because they can't be cheaply or easily replaced.
Right.
And this severe supply constraint, it isn't just theory,
Yeah.
We see it playing out in the hard data from Atlas Real Estate.
What do their numbers say?
So they noted that nationally, active listings did see a slight rebound to roughly 1.1 to 1.5 million units in late 2025.
Okay, so a little bit of a bump.
Yeah, a slight bump, but you have to translate that raw number into a metric that actually means something to the market,
Right.
which is months of supply.
Okay, so months of supply, meaning, just to clarify for everyone, if not a single new house was listed for sale starting tomorrow, how many months would it actually take for buyers to purchase every single house currently sitting on the market?
Correct. That's exactly it. And Atlas puts the current inventory at about 4.4 months of supply.
Is that good or bad?
Well, to put that in context, a balanced housing market, one where neither the buyer nor the seller holds all the leverage and prices are relatively stable, that requires 5 to 6 months of supply.
Wow, okay.
So even with that recent slight rebound in listings, we are still operating in a historically tight, really supply-constrained environment.
Man, and we can't even just blame the developers for not building, right?
Right, not at all.
Because our sources emphasize that there are these deep structural hurdles actively preventing new supply from coming online, even if a developer actually wanted to build.
Oh, yeah, we're talking about incredibly strict zoning laws.
Right. Zoning is a massive bottleneck.
It really is. In
Yeah.
many highly desirable areas, you have these Euclidean zoning laws that strictly prohibit building anything other than single-family homes on, large lots.
You can't just buy a place and put up a duplex.
Exactly. You cannot legally tear down an old house and build a 4-unit property to increase density.
That's wild.
And then you add in dense land use regulations, environmental impact studies, local opposition to new development, and the timeline to build just gets stretched by years.
Not to mention just the lack of space.
Right. Furthermore, in landlocked metropolitan areas or, coastal cities, there is simply a sheer lack of buildable land.
Yeah, I mean, you cannot just manufacture more acreage in Miami or Seattle.
Exactly. So the supply side of the scale is just locked down tight.
Okay, so supply is constrained, but then on the demand side, we have this great psychological barrier, which is interest rates.
It's a big, scary number.
Right. The headlines just terrify people. Buyers see mortgage rates hanging in the low to mid 6% range, and they are completely paralyzed by this fear of locking in a bad deal.
And the fear is understandable, but Morgan Stanley's research suggests the context is actively shifting right now. Well, we are moving past the peak panic. Their forecast indicates that mortgage rates are expected to, gradually decline, moving from the current mid-sixes toward the 5.5 to 6% range as we head into 2028 and 2029.
Which I know a 0.5% drop doesn't sound like a lot to someone outside of finance.
Right. It sounds tiny.
Yeah, but on a 30-year loan for a $400,000 asset, that 0.5% fundamentally changes the monthly payment and the overall buying power of the consumer.
It creates a really meaningful improvement in liquidity.
Yeah.
And here is the crucial strategy that institutional investors are deploying right now, which the Morgan Stanley report specifically highlights.
What's their play?
Because the market has been sluggish and transaction volumes have been so low for the past 2 years, aggressive buyers are able to acquire assets at 20 to 25% below their peak values.
Wait, 20 to 25% off?
Yes.
So a commercial property that traded for, let's say, $10 million in 2021 might be changing hands for $7.5 million today.
Exactly. And often that reduced purchase price is actually below the replacement cost.
Wow. Okay.
Meaning an institution is buying an existing building for less money than it would cost to actually hire a construction crew and build the exact same building today.
Oh, that is wild.
Yeah. So when you combine assets priced below replacement costs, an easing trajectory for interest rates, and structurally constrained future supply.
That is the exact recipe for a market recovery.
Exactly. It's the perfect storm for a rebound.
That makes total sense. So you buy the asset at a discount today, you lock in the constrained supply, and if rates drop in 3 years, the asset value appreciates while you just refinance the debt.
That's the playbook.
And our sources have also mentioned that these massive institutions are using real estate for geopolitical hedging.
Yes.
I want to touch on that briefly because I feel like it explains why so much big money is pouring into physical assets rather than just, staying in the stock market.
It's a really important point. We are operating in a world of rising geopolitical tensions, shifting trade alliances, ongoing global conflicts, all of that.
Yeah, it's pretty chaotic right now.
And all of those factors create immense volatility in equities and supply chains. And institutional capital just hates volatility.
Right. They want stability.
Exactly. So physical real estate acts as a durable income-producing hedge against that inflation and instability.
Yeah, because a logistics warehouse or an apartment building, it's a tangible asset.
It's physical, it's there.
Right. It generates monthly cash flow regardless of what the stock market decides to do on a random Tuesday.
Exactly. And historically, as inflation pushes the cost of building materials up, the value of the existing real estate just rises right alongside it.
Right, because if it costs more to buy bricks, the brick building you already own just naturally becomes more valuable.
Exactly.
So the macro environment is waving this massive green flag. The inflection point is here.
It is.
But, the real estate market is not a monolith.
No, not at all.
It's not one giant dial that just turns up or down everywhere all at once. So if the smart money is moving, where exactly are they placing their bets?
That's the key, because Morgan Stanley makes it very clear that this recovery is heavily divided by sector.
Okay.
The divergence in the commercial market right now is just extreme. You cannot just buy any building in any city and expect it to appreciate.
The rising tide lifting all boats thing is over.
The era of the rising tide lifting all boats is completely over. Active management and highly specific asset positioning are like the only ways institutions are generating returns right now.
Okay, so let's trace the flow of the institutional capital. Where are they actually going?
So the strongest magnet for capital right now is the industrial sector.
Interesting.
And this ties directly back to those geopolitical tensions we just talked about.
Okay, how so?
We are witnessing a massive historic supply chain realignment. Following all the disruptions of the last few years, major corporations are actively moving their manufacturing and supply chains away from China to diversify their risk.
Ah, right. Friendshoring and nearshoring.
They
They are moving factories back to North America or to allied nations. So a trade war or a localized shutdown doesn't just freeze their entire business.
Spot on. And in the United States specifically, this translates to a boom in advanced manufacturing and defense-related production.
Okay.
And every time a new high-tech factory opens in the Midwest or the Sun Belt, that factory requires a sprawling network of logistics hubs, distribution centers and warehouses to support it.
So all the support buildings.
Right. The demand for industrial space near these new manufacturing centers is just incredibly robust right now.
Wow, that is a perfect example of how a headline about international trade directly increases the rent on a concrete warehouse in, Ohio.
Exactly. It all connects.
Okay, so industrial is huge.
Yeah.
What is the next big institutional play?
Data centers.
Ah, of course.
Yeah, the demand profile here is unlike anything we have seen in recent history, and it's driven almost entirely by the artificial intelligence boom. Major tech companies are in a complete arms race, pouring unprecedented billions into the physical infrastructure required to run these AI models.
And data centers are not just empty warehouses, right? You can't just put a server rack in a standard office building and call it a day.
Oh, not at all. They require immense specialized power grids and these incredibly sophisticated liquid cooling systems that most municipalities simply cannot even support.
Wow.
Because they are so difficult and expensive to build, the supply is severely constrained, which makes the existing operational data centers incredibly valuable assets.
That makes total sense. Okay, what about healthcare? Because structurally speaking, people get older, people get sick, they always need medical care. That seems like it would be the ultimate recession-proof investment.
You know, it's interesting because healthcare real estate is actually experiencing a fascinating internal split right now.
Really?
Yeah. On one side, you have senior housing, which is just booming. We have a rapidly expanding demographic of people aged 75 and older. But what makes this unique in the U.S. is how it's being funded.
How so?
Many baby boomers are actually paying for high-end senior living by selling off their primary residences, tapping into decades of immense accumulated home equity.
Oh, wow, that's a huge pool of capital.
It's massive. And similarly, outpatient medical offices are performing very well because the entire healthcare industry is moving away from massive centralized hospitals toward local specialized clinics.
But I'm guessing there is a loser in the healthcare space right now.
Unfortunately, yes. Life sciences.
Aha. Okay.
During the pandemic, there was this absolute frenzy to build specialized laboratory and research space. Everyone wanted in on biotech.
Oh, yeah. I remember that.
But today, there is a significant oversupply of that lab space. Furthermore, the life sciences sector relies heavily on early-stage venture capital funding to survive while they, develop drugs.
And in a 6% interest rate environment, venture capital tightens up significantly.
Exactly. Without that VC funding, these startups literally can't pay the rent. So you have these newly built, beautiful lab spaces just sitting empty, and even large public biotech firms are trying to sublease their excess square footage.
Ouch. Okay, well, let's round out the commercial side with the two sectors everyday people actually see all the time, right?
Yeah.
Office buildings and self-storage.
Right.
I have to assume the office sector is still just an absolute bloodbath from the remote work shift.
Well, it is stabilizing a bit, but it still faces just monumental headwinds. It's a highly bifurcated market right now.
What do you mean by bifurcated?
So what we call Class A properties, the newest buildings in prime locations with top-tier amenities, they are actually seeing record high rents.
Oh, really?
Yeah, companies want the best possible space to lure their employees back to the office. But the vast majority of older Class B and Class C office buildings are really struggling.
And the Morgan Stanley report points out a hidden cost for these older buildings too, doesn't it?
Yes, environmental, social, and governance standards, or ESG.
Right.
Many older office buildings are basically obsolete when it comes to energy efficiency. So to attract corporate tenants who have these strict carbon tracking mandates, landlords have to spend millions retrofitting HVAC systems and, upgrading windows.
Wow, millions.
Yeah, and if the building doesn't generate enough rent to justify those massive upgrade costs, it basically just becomes a stranded asset.
Just to total write-off.
No.
Okay, and what about self-storage? Because that industry used to be like the golden child of steady cash flow.
It was. But self-storage is currently a victim of the residential housing freeze.
How does that connect?
Well, the primary driver of self-storage demand is people moving, downsizing, upgrading, relocating.
Oh, sure.
But because those 6% mortgage rates have basically trapped homeowners in their current houses, the velocity of moving has just plummeted.
Right, nobody's moving.
Exactly. If people aren't packing up their houses, they aren't renting storage units for their overflow belongings.
Okay, I'm going to throw a flag on the play right here.
Fair enough.
Because this commercial breakdown is objectively fascinating. Like, understanding how venture capital interest rates affect lab space in Boston, or how, carbon emission standards are stranding office buildings in Chicago, that is great macroeconomics.
It is really interesting data.
It is. But we have to be real with the listener.
True.
If you are a beginner trying to figure out how to invest your very first $50,000, commercial real estate is entirely out of reach.
Completely.
You cannot syndicate a $50 million data center. You do not have an army of analysts to figure out the ESG upgrade costs on a mid-rise office building.
Right, it's just not practical.
So if the macro environment is pointing to a recovery, but commercial is a rich man's game, where does the everyday beginner actually start?
That is the absolute pivotal question, and it is exactly why beginners must pivot their focus entirely away from commercial complexity and just look at the other side of our source material, the residential market, specifically single-family homes or small 2 to 4 unit multifamily buildings.
The beginner's sweet spot.
Without question. The beginner's guide and the Atlas data we reviewed make a really compelling case for single-family rentals.
Why is that?
Well, they are fundamentally easier to understand, primarily because everyone understands how a house works.
Right.
They are exponentially easier to finance using just standard residential mortgages. And crucially, they allow a beginner to isolate and control their risk in a way that is just fundamentally impossible in a huge commercial syndication.
Okay, so let's explore the mechanics of the residential rental market then. Because to make money on a rental, you obviously need a deep, consistent pool of people who actually want to rent.
Yes.
So why is renting so resilient right now, especially when the quote-unquote American dream has always been geared toward homeownership?
It all really comes down to the barrier to entry for buying. We have historically high home prices colliding with 6% mortgage rates.
It's a brutal combo.
It is. That combination has absolutely destroyed purchasing power. Households that historically would have bought a starter home in their late 20s simply cannot make the math work today.
The monthly payment on a starter home is just too high.
Exactly. So they are forced to remain in the renter pool for years longer than previous generations.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
And according to the Atlas Real Estate data, it's not just a stagnant pool of frustrated buyers, is it?
No, not at all.
Because there are two massive generational forces colliding right now that are basically pouring gasoline on rental demand.
Yes, it is a phenomenal demographic tailwind.
Okay, lay it out for us.
Picture it like a barbell. On one end, you have Gen Z. They are graduating, entering the workforce, and moving to new cities.
Right.
But because of the affordability crisis, they are entering the housing market strictly as renters. They are supplying massive demand at the entry level.
Okay, and on the other end?
On the other end of the barbell, you have the baby boomers. The oldest generation is aging, their kids have moved out, and they are actively choosing to downsize.
Right, they want to cash out.
Exactly. They want maintenance-free living, flexibility, and honestly, they just don't want to mow a lawn anymore.
Fair enough.
So they are selling their large suburban homes and moving into premium rentals.
Wow, so you have the youngest generation and the oldest generation both dumping massive demand into the rental market at the exact same time.
Exactly. And this is exactly why single-family rentals, often referred to as SFRs, are so perfectly positioned right now.
How so?
Well, a millennial family with a dog and a toddler might be priced out of buying a house, but they still desperately want the lifestyle of a house.
Right.
They want the fenced yard, the good school district, and no shared walls with noisy neighbors.
Yeah, apartment living gets old.
It really does. So if they cannot afford the bank's mortgage, they just rent the single-family home from an investor instead.
Which gives the investor incredible pricing power.
Exactly.
In fact, Atlas notes that because of this sustained demand, combined with the slowdown in new housing completions we talked about earlier, national rental prices could actually increase by another 2 to 3% by the end of 2026.
And keep in mind that is just a national average.
Right.
Real estate is hyperlocal, and there are specific markets moving at breathtaking speed right now.
Like where?
Atlas specifically highlights high-growth states like Florida, Arizona, and Colorado, where the migration patterns are driving incredible absorption rates.
Okay, let's define that term for the listener. What exactly is an absorption rate?
Sure. Absorption rate measures how fast available homes are purchased or rented once they hit the market. It basically indicates the velocity of demand.
Okay.
For example, Atlas projections for early 2026 show that in Florida, 2.37% of homes are expected to hit the market and actually sell within a 90-day window.
Wait, 90 days.
90 days.
That means from the moment the photographer takes the listing photos, to the open house, to the contract, to the bank financing, to handing over the keys at closing. All of that happens in under 3 months for a massive chunk of the market.
It is a staggering pace.
It's crazy.
But it proves that even when that much-needed supply finally trickles onto the market, the pent-up buyer and renter demand instantly just swallows it whole.
Okay, but this raises a massive red flag for me, and it really should for anyone listening.
What's that?
If I am a beginner and I'm looking at a market in Florida or Colorado where houses are vanishing in weeks, how do I not just get slaughtered by the competition?
It's a very real concern.
Because the natural instinct when you see 3 other couples touring a house you want is to panic. Right?
Oh, totally.
You throw logic out the window, you waive the inspection, you bid $20,000 over asking just to win the price.
And you are describing the exact mechanism of emotional buying, and it is honestly the absolute fastest way for a beginner to destroy their capital.
So how do we avoid it?
The overarching rule synthesized from all of our sources is this: you do not chase the hottest market. You do not chase the headlines. You chase the market where the math actually works.
Man, I love that. You chase the math.
Yes.
So let's actually do the math right now. I want to spend a serious amount of time here.
I think we should.
Let's take off our macroeconomics hats, put on our investor hats, and meticulously walk through the exact financial scenario provided in our beginner's guide source text.
Let's do it.
Because if you are listening to this and you understand this one breakdown, you possess the mental framework to evaluate literally any residential property on Earth.
Exactly. Let's walk through it step by step. Every successful real estate deal starts with setting the scene and understanding your true initial capital requirements.
Hey, I have this scenario from the text pulled up here. We are analyzing a listing for a standard 3-bedroom, 2-bathroom, single-family home.
Okay.
And the asking price is $290,000.
A very realistic entry-level price point in many Midwestern or Sunbelt markets.
Right.
Now, assuming you are buying this strictly as an investment property and you are not going to live in it, you will generally be using a conventional investment loan.
Okay.
Banks view investment properties as higher risk than primary residences, so they require a larger buffer. You will need to put down 20%.
Okay, so let me pull up my calculator. 20% of $290,000.
Yeah.
That means I need to wire $58,000 in cash to the title company for the down payment.
Exactly. That is your hard capital in the deal.
Got it. Which leaves me needing a loan from the bank for the remaining balance, which is $232,000.
Right. Now we apply the cost of capital. Based on the 2026 environment in our scenario, we are going to borrow that $232,000 at a 6% interest rate, locked in on a standard 30-year fixed mortgage.
Okay, so I'm running that through a standard amortization calculator. On $232,000 loan at 6% over 30 years, the principal and interest payment, the P&I that comes out to roughly $1,400 a month.
Correct.
That is the check I have to cut to the bank every 30 days forever, no matter what happens.
No matter what.
Now, if I rent the house out for $2,100 a month and my mortgage is $1,400, I'm making $700 a month in pure profit.
All right.
I'm basically a real estate mogul.
Well, that is the exact rookie assumption that leads straight to bankruptcy.
Yeah.
Your mortgage payment is merely the baseline. You have entirely ignored the operating expenses, or OPEX.
Wait, what exactly is OPEX?
These are the mandatory, recurring, and hidden costs required to keep the building physically standing and legally compliant.
Oh.
If you don't calculate OPEX, you don't have a business, you have a liability.
The joys of homeownership, right?
Exactly.
Okay, let's break down the OPEX line by line based on the guide. First up, property taxes.
Always a big one.
Yeah, the text estimates taxes on this house at $3,600 a year, which breaks down to about $300 a month. But a quick question on this. Where does a beginner even find that number, and can they actually trust it?
That is a fantastic question. You can find the current property tax on the county assessor's website or usually right on the Zillow listing.
Okay, that's easy enough.
But here's the trap. You cannot always trust the previous owner's tax bill.
Why not?
Because in many municipalities, the moment the property changes hands at a new, higher purchase price, the county triggers a reassessment.
Oh, wow.
Yeah, so 6 months after you buy the house, the county updates the value and your tax bill suddenly jumps by $1,000 a year.
Ouch, that would hurt.
You have to run your math based on the post-sale assessed value, not the historical value.
That is a critical tip right there.
Okay.
Okay, so we budget $300 a month for taxes.
Right.
Next is homeowner's insurance. The estimate in our scenario is roughly $1,200 a year, so that is another $100 a month.
And this really requires vigilance right now. As we discussed with high-growth states like Florida or Colorado, climate risks, hurricanes, wildfires, they are causing insurance premiums to just skyrocket.
Yeah, I've heard horror stories.
Exactly. That $100 a month could easily be $250 a month in a coastal market. You absolutely must get a real insurance quote during your due diligence phase.
Okay, noted. Next on the OPEX list is the maintenance buffer.
Yes.
Because you have to set aside cash every single month for the inevitable repairs, right?
Yeah.
The dishwasher leaks, the garbage disposal jams, the tenant breaks a blind.
It never ends.
Our text suggests a buffer of about $100 a month for a home in good condition.
And I want to clarify the difference here between maintenance and capital expenditures, or CapEx.
What's the difference?
Maintenance is the $150 plumber visit to unclog a drain. CapEx is the $8,000 roof replacement every 20 years.
Okay, much bigger scale.
Right. So while $100 a month covers basic maintenance, you also really need to understand the lifespan of the major systems in the house to avoid a catastrophic surprise down the road.
Okay, we will definitely dig into CapEx in a minute, but let's finish our monthly OpEx first.
Sounds good.
The final and perhaps most overlooked line item, the vacancy buffer.
Yes. You cannot build a financial model assuming the property will be rented 100% of the time, 365 days a year, for a decade.
It's just not realistic.
Not at all. Tenants move out. It takes a week to paint, a week to clean, and maybe 2 weeks to find a new qualified tenant. You will experience empty months.
So the text uses a standard 5% vacancy buffer.
Right.
To calculate that 5%, we look at the projected rent. The scenario states we can rent this 3-bedroom home for $2,100 a month.
Mm-hmm.
So 5% of $2,100 is $105.
Exactly.
So we literally have to pretend we are lighting $105 on fire every single month, putting it in a separate account to cover the cost of the house when it inevitably sits empty.
That's a great way to think about it. So now we can calculate your true effective revenue.
Okay.
You start with your top line rent of $2,100. Right off the top, you subtract that $105 vacancy buffer. Your effective gross income is actually $1,995.
All right, so I have $1,995 in real money coming in. Now let's subtract the operating expenses we just audited. Go for it. We have $300 for taxes, $100 for insurance, and $100 for maintenance. That totals $500 in monthly OpEx.
Okay, so now take your effective income of $1,995 and subtract the $500 in operating expenses.
Right.
The resulting number is the most important metric in real estate. Your NOI, or net operating income. In this scenario, your NOI is roughly $1,495 a month.
$1,495 a month. But wait, I haven't even paid the bank yet.
Correct. The net operating income is a measure of how the property performs, completely independent of how you chose to finance it.
Oh, I see.
It is the money the building generates before paying your debt. So now you take that $1,495 NOI and you subtract your $1,400 principal and interest mortgage payment.
Which leaves me with exactly $95.
Yeah. The text estimates the final cash flow at roughly $95 to $200 a month, depending on, minor local variations in insurance or taxes. But yes, you have arrived at the bottom line.
$95 a month. I'm going to be honest. I just put $58,000 of my hard-earned cash down on this house, and I'm clearing less than $100 a month.
I know, it sounds low.
That does not sound like a pathway to massive wealth.
Well, it is a modest cash flow, which is honestly entirely typical for a beginner entering a higher interest rate environment.
Okay.
But let's look at the professional metrics the text provides to evaluate that return. First is the cap rate, or capitalization rate, which is roughly 5.1% here.
Can you translate cap rate for someone who has never taken a finance class?
Sure. A cap rate is your unleveraged yield.
Unleveraged meaning no debt.
Exactly. If you had walked up to the seller and bought this $290,000 house in all cash, no bank, no mortgage, your net operating income of $4,495 a month equals about $17,900 a year.
Okay.
If you divide $17,900 by the $290,000 purchase price, you get an annual return of 6.1%. Wait, let me adjust that based on the text's specific expense variations.
Sure.
The text specifies a cap rate of approximately 5.1%. That means the property yields 5.1% a year on its total value, completely free and clear of debt.
Okay, that makes sense. And the other metric mentioned is the cash-on-cash return.
Right, and this one is much more personal. It measures the actual cash you get back relative only to the cash you put in.
Okay, so I put in a $58,000 down payment.
Yes. If your cash flow is on the higher end of the estimate, say $200 a month, that is $2,400 a year in profit.
Right.
Divide $2,400 by your $58,000 initial investment, and you get a cash-on-cash return of roughly 4.1%.
Okay, so if I'm making 4.1% on my cash and keeping maybe $100 a month in my pocket, why on earth would I do this instead of just, putting my $58,000 in a high-yield savings account or an index fund?
It's a fair question, but it's because cash flow is only one of the 4 ways real estate actually makes you wealthy.
What are the others?
Yes, the cash flow is modest, but simultaneously, your tenant's $2,100 rent check is paying down the principal balance on your $232,000 loan every single month.
Oh, right. They're buying the house for me.
Exactly. You also get significant tax depreciation benefits to shield your income.
Nice.
And historically, the physical value of that $290,000 asset is appreciating over time, acting as that inflation hedge we discussed earlier.
That makes total sense. The cash flow isn't the whole return. It's really just the liquid part.
Exactly.
But it serves a vital purpose, which leads us to my absolute favorite part of the beginner's guide.
Oh, the stress test.
The stress test. The crucial what if. What if we didn't buy on a good day? What if we could only qualify for a 7% interest rate instead of 6%?
Well, let's run the exact same property through the stress test.
Let's do it.
If your interest rate moves from 6% to 7%, the cost of borrowing that $232,000 suddenly jumps. Your principal and interest payment climbs from $1,400 to approximately $1,600 a month.
But the property itself hasn't changed. The rent is the same. So
Yep.
my net operating income is still locked at $1,495.
Exactly. The building's performance is identical, but now your debt service is $1,600, while your NOI is only $4,495.
Wow.
So your cash flow doesn't just shrink, it immediately inverts. It goes negative. You are losing over $100 a month out of your own pocket just for the privilege of keeping the property afloat.
Man, I love visualizing this with an analogy. I think of cash flow like a physical shock absorber on a car.
Ooh, I like that.
Right, because if you have a massive heavy-duty shock absorber, meaning a lot of positive cash flow, let's say $800 a month, you can hit a pothole.
And you're fine.
Yeah. A tenant leaves a month early, or the washing machine floods the laundry room. The shock absorber compresses, but you bounce right over the pothole. The car keeps driving.
But if your cash flow margin is razor thin,
Like our $95 a month, or if it is negative, you have zero shock absorber.
you are riding directly on the frame.
Exactly. Every single minor bump in the road, a $300 plumbing bill, a minor hike in property taxes, hits the frame of the car and just shatters the axle.
Yeah, and you are suddenly forced to pull money out of your W-2 paycheck or your savings account just to keep your investment from going into foreclosure. That is a phenomenal way to conceptualize risk. That positive cash flow is your margin of error.
It really is.
And doing this math exercise manually, it proves why you can never get emotionally attached to a house.
Right.
The kitchen might have beautiful granite countertops, the neighborhood might have great schools, but if a 1% shift in the cost of capital turns the investment into a monthly liability with no shock absorber, you must close the spreadsheet and walk away.
Just walk away.
Yeah.
So we have built the model on our spreadsheet. The numbers work. But real estate happens in the physical world, involving banks, inspectors, and local laws.
Yes, it does.
How do you, the listener, take this mathematical model and actually execute it without falling into the classic rookie traps?
Well, our sources, particularly the beginner's guide, synthesize this transition from theory to execution into a very clear 8-step action plan.
Okay, an 8-step plan.
And the brilliance of a checklist is that it removes the emotion and forces you into a strictly procedural mindset.
Let's walk through these 8 steps and really explain how a beginner actually accomplishes them. Step 1, define your goal.
You cannot hit a target you haven't identified. You really need to know what game you are playing.
Right, what's the end game?
Exactly. Are you a high-income earner looking for long-term appreciation and tax write-offs over a 20-year horizon? Or are you looking for immediate monthly cash flow to supplement your current salary and eventually replace your job?
Because those require totally different properties.
Completely different. If you want pure cash flow, you might look at multifamily duplexes in the Midwest. If you want high appreciation, you might look at single-family homes in the path of growth in the Sun Belt. Your goal dictates your geography.
Step 2, pick one market to learn deeply.
This is huge. One of the biggest mistakes beginners make is opening Zillow and looking at houses in Texas, Ohio, and Florida all on the exact same afternoon.
Guilty.
You end up knowing a little bit about everything and nothing about anything. Pick one specific geographic market, often a single metropolitan area or even a cluster of ZIP codes.
Then how do they actually learn it deeply? What data are they looking for?
You look for the macro drivers of housing, go to the Bureau of Labor Statistics website, and look up the job growth rate for that specific county.
Okay.
Are major employers moving in or factories shutting down? Look at the population growth trends. Review the local school district ratings. Understand the average rent for a 3-bedroom house.
You really have to do your homework.
You need to become an absolute expert in one ZIP code before you ever try to be an expert in 2.
Got it. Step 3, build a property checklist.
This is your objective filter. Create a rigid list of non-negotiable requirements before you look at a single listing.
Give me some examples of that.
What is your absolute maximum purchase price? What is the minimum rent it must generate? Are you willing to buy a house with a pool, or is the liability too high?
Good point on the pool.
Are you willing to replace a roof, or does it need to be move-in ready? If a property hits your desk and fails even one mandatory checklist item, you discard it immediately.
No exceptions.
No exceptions.
All right. Step 4, Run the math on at least 2 sample properties.
This is exactly what we just did with the $290,000 house. Before you ever look for a real deal, take 2 active random listings off the internet and run them through your spreadsheet.
Just to practice.
Exactly. Call an insurance agent to get a fake quote. Look up the real taxes. Practice calculating the NOI and running the stress test so that when a real deal pops up, you aren't fumbling with the calculator.
Step 5. Get pre-approved for financing. This is where it gets very real.
Yes.
You need to understand your capital options before you make an offer.
Your financing shapes the entire profile of the deal. Getting pre-approved tells you exactly what interest rate the bank will give you, which is the absolute cornerstone of your math.
Right.
But it also dictates your strategy. Are you using a standard conventional loan requiring 20% down?
What if a beginner doesn't have 20%? I hear a lot about FHA loans.
The Federal Housing Administration, or FHA, offers loans that require as little as 3.5% down.
Wow, that's a huge difference.
It is, but there is a massive catch. They are strictly for owner-occupied properties. You cannot buy a purely investment rental with an FHA loan.
Oh, I see.
However, a popular beginner strategy, often called house hacking, is to use an FHA loan to buy a duplex, live in one unit, and rent out the other.
Oh, that's smart.
Right. The rental income from the second unit offsets your mortgage. Alternatively, if you are buying an asset that standard banks don't like, you might need a portfolio loan, where a local bank keeps the loan on their own balance sheet rather than selling it to Fannie Mae, which allows for more flexible asset-based underwriting.
Okay, a lot of options there. Step 6, build a reserve fund.
Never, ever spend your last dollar on the down payment.
That sounds incredibly stressful.
It is. We talked about the shock absorber. A reserve fund is the cash that fuels the shock absorber.
Right.
The guide strongly recommends holding a minimum of 3 to 6 months of total property expenses in a liquid savings account, completely separate from your personal emergency fund.
Yeah, because if the roof leaks and the tenant stops paying rent in the same month, this reserve fund is what prevents you from defaulting on the mortgage.
Exactly. It's your lifeline.
Step 7, start small.
The internet is full of gurus telling you to buy a 50-unit apartment complex for your first deal.
Yeah, that sounds like a terrible idea.
Ignore them. Buy one property, a standard single-family home or a duplex. Use this first property as your real estate MBA.
I like that framing.
Learn how to manage a tenant, learn how to dispatch a plumber, learn how the bookkeeping works. Make your beginner mistakes on a small scale where they won't bankrupt you.
And finally, step 8, schedule a monthly market check-in.
Because once you own the property, the research doesn't start.
Right.
Set a calendar alert once a month to pull your head out of the sand. Check the current rental listings in your neighborhood. Are rents going up or down? Watch the local vacancy rates.
So keep your finger on the pulse.
Yes. Keep an eye on housing supply data. Anticipating a local economic downturn gives you time to react before it actually impacts your bottom line.
Those 8 steps provide an incredible roadmap because they force a beginner to just slow down and act methodically.
Exactly.
But even with a perfect checklist, the physical real estate world is full of landmines.
Oh, for sure.
What are the most common catastrophic rookie mistakes the experts see out there?
Well, we touched on the biggest one during our math segment. Overestimating rent and underestimating expenses.
The classic trap.
A beginner looks at a beautiful house and assumes they can charge the absolute highest rent in the neighborhood, while simultaneously assuming nothing will ever break, and they can just manage the property themselves for free.
Yeah, rose-colored glasses.
You must build your model using conservative estimates. Assume lower rent, assume higher taxes, and budget for property management even if you plan to do it yourself.
Why budget for it if I'm doing it?
Because eventually, your time will become way too valuable to be fixing toilets on a Sunday.
Fair point. And I would assume ignoring capital expenditures, or CapEx, ruins a lot of first-year investors too.
It is the silent killer of returns.
How so?
A roof has a lifespan of roughly 20 to 25 years. An HVAC system might last 15. A water heater lasts 10.
Okay.
If you buy a house where all the major systems are 15 years old and you don't budget for their eventual replacement, you are holding a ticking time bomb.
Just waiting to go off.
Exactly. A sudden $7,000 furnace replacement will wipe out 3 years of your $200 a month cash flow in a single afternoon.
Wow, yeah, that is brutal, which highlights exactly why the due diligence phase is so critical, right?
Yes.
Because you find a house, the spreadsheet math works perfectly, the cap rate looks amazing, but now you actually have to verify the physical integrity of the asset.
Never, under any circumstances, waive a professional property inspection just to win a bidding war.
Even in a hot market.
Even in a hot market. That is exactly how you end up buying a house with a cracked foundation or severe termite damage.
Yeah, no thank you.
You hire a licensed inspector to check the plumbing, the electrical panels, the structural integrity. The $500 you spend on an inspection is the absolute best insurance policy in the world.
But due diligence isn't just about the physical wood and concrete, is it? You have to inspect the legal reality of the property, too.
Absolutely. You must review the Homeowners Association or HOA documents. This is a classic rookie trap. You buy a condo or a home in a managed community planning to rent it out. 2 months later, the HOA board votes to cap rentals at 10% of the neighborhood, or they ban short-term rentals entirely.
Oh, man, and then what?
Your entire business plan is rendered illegal overnight, and you are stuck with a mortgage you can't pay.
That is terrifying.
It happens all the time. You also must understand the local landlord-tenant laws. How long does an eviction take in that county? Is it a landlord-friendly state or a tenant-friendly state?
So the regulatory environment is just as important as the physical foundation.
Exactly.
Man, we have spent a lot of time talking about digging through municipal tax websites, researching Bureau of Labor Statistics data, analyzing HVAC lifespans. It honestly sounds like an overwhelming amount of homework for someone working a standard 9-to-5 job.
It can definitely feel that way.
But the Atlas real estate data highlights something really fascinating about how the burden of this homework is fundamentally changing. They talk about technology acting as a massive equalizer in this industry right now.
And this is perhaps the most exciting shift for beginners in the modern era.
Yeah.
Historically, the massive institutional investors had this insurmountable advantage because they employed armies of analysts and used proprietary million-dollar software to crunch demographic data and find the best deals.
Right. Wall Street always had the better data.
They did. But today, everyday investors are gaining access to incredibly sophisticated AI-driven valuation models and predictive analytics.
Like just normal people can use this.
Yes. Digital platforms are vastly improving market transparency. A beginner on a laptop can now pull up a dashboard that instantly aggregates rent trends, cellular migration patterns, climate risk profiles, and historical tax data for a specific ZIP code.
Stuff that used to be impossible to find.
Analysis that used to take a team of interns 3 full weeks to compile. The data asymmetry is totally collapsing. The tools required to do institutional-level math are now available to anyone with an internet connection.
Okay, let's bring this entire deep dive full circle. We started with a big, intimidating question facing every beginner looking at this chaotic market. Is 2026 actually a good time to get into real estate?
Yes.
If we synthesize the Morgan Stanley inflection thesis, the Atlas demographic data, and that rigid mathematical framework we just built, the answer seems to be a highly calculated yes.
It is a yes, provided you operate within reality.
Right.
2026 represents a legitimate inflection point. Yes, the cost of capital is higher than the historic artificial lows of 2021, but the deeply entrenched structural supply shortages mean that existing residential properties hold immense durable value.
Yeah.
And the demand side of the equation is incredibly strong, supported by the massive demographic collision of Gen Z entering the market and baby boomers downsizing into rentals.
So if a beginner pivots away from the complexity of commercial real estate, sticks strictly to residential properties, runs conservative math that includes a healthy shock absorber for capex and vacancy, and uses a checklist to avoid emotional bidding, they can absolutely enter this 2026 market safely and profitably.
Precisely. The macro fundamentals support the entry, and the micro math protects the investor.
But before we wrap up, I want to pull on that technology thread one more time, because it raises a highly provocative thought for you, the listener, to take away today.
Oh, I like where this is going.
We just discussed how AI valuation models are currently democratizing data, giving you, the beginner, the exact same analytical power as the massive Wall Street institutions. But let's extrapolate that just a little bit further into the future.
This is where the efficiency of the market becomes highly philosophical.
Right. As these predictive AI tools become increasingly cheap, ubiquitous, and accessible to literally everyone with a smartphone, what actually happens to the landscape of real estate investing?
It's a great question.
if every single beginner, every mom and pop landlord, and every institution has an AI agent that is instantly calculating the cap rate, cross-referencing local job growth, and identifying the highest yielding properties the exact millisecond they hit the MLS,
Yeah.
does the concept of a hidden gem deal just go extinct?
It is a profound question about the future of the industry. If the market becomes perfectly frictionlessly efficient because algorithms are doing the underwriting in microseconds, how do you find an edge?
Yeah, exactly.
If the map, the very thing we just spent this entire deep dive learning how to meticulously execute manually, is being instantly perfected by machines, how do you compete?
Will the human element still matter?
Right. Does the human element of investing, the ability to negotiate with a distressed seller or the vision to see the potential in a blighted neighborhood, does that survive that level of technological efficiency?
It is definitely something to mull over the next time you open up a real estate app and marvel at all the data right there at your fingertips.
Absolutely.
Well, thank you so much for joining us on this deep dive into the 2026 real estate landscape.
It's been great.
Do not let the confusing headlines or the fear of higher rates intimidate you into paralysis. Grab a spreadsheet, pick your target market, and start building your non-negotiable property checklist today. The math is out there waiting for you.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.